Man, do I love reading news like this. Oh, for all the times I had to withstand the silver slams and the blatant manipulation that we all knew was being done by one entity known as JP Morgan. Oh, oh, this feels good. Oh, man, this feels great. JP Morgan suffers big loss. What? JP Morgan suffers big loss. CNN Money, May 10th, 2012. 7:20 Eastern Standard Time. Is this, did that say April 1st, like April Fool's Day? No. No, it didn't. It said today. Huh, let's go on here. New York, CNN Money. JP Morgan Chase, in a surprise announcement, said Thursday that it has suffered trading losses of $2 billion since the start of April. The group that suffered the losses is part of the bank's so-called corporate unit and had been making trades designed to hedge against risk. That group, by the way, was supposedly ran by that. Remember we heard about this about a month or so ago? This one trader, the biggest trader in the world. I can't. Maybe they mentioned his name in this. I don't see it. Just looking down. They called him the Whale. His nickname, the Whale. This guy handles trillions of dollars of activity or whatever. This guy's the Whale. And as Bix Weir said not too long ago, after Greece basically is done. I mean, they're still trying to push that thing along, but they basically, with what happened with their parliament, they can't come to a new majority government or party, anyways. The bailouts are done, basically. So, having said that, now there's losses. Now, before that, we also had the ISDA call the default a default finally. So now some of the credit default swaps had to get paid. That's insurance on that debt. And as Bix Weir said, hey, they're only showing like $2 billion in losses right now. There's more parties involved. Let's just sit back a little while and wait and see. And when this does happen, let's see if they go with the old rogue trader thing. Oh, we're going to go after that sucker. We're going to find who did this, who caused us these losses. This was a rogue trader. We're going to have to deal with him. That's exactly what Bix Weir was talking about. Some other people too. As soon as it comes over here and we hear our banks talking about it and they got, stabbed in the back, the big losses, they're not going to say we were betting on these bets called derivatives. That's a bet on a bet. And there's trillions of dollars worth of them, hundreds of trillions. And we are guaranteed to lose eventually. As soon as one piece of our puzzle goes away, it's a chain reaction, and it starts affecting us bank by bank by bank by bank. They can't say that. They have to say, well, a rogue trader caused this. Not to tell you the truth, that the entire financial system can be destroyed by such an event. They can't tell you that. No, can't tell you that. We got to blame it on somebody. The group that suffered the loss is part of the bank's so-called corporate unit and had been making trades designed to hedge against risk. Net losses after factoring in other security gains could exceed $800 million by the end of the second quarter. And from what I was reading in another place, it could be a total of $4 billion that they lost. Having said that, they also gained about $2 billion in profits doing other things. So the net loss could be around $2 billion potentially. As it says here, could exceed $800 million. The unit had been expecting to post a net gain of $200 million. Shares of JP Morgan, Fortune 500 company, fell sharply in trading after the market closed, with losses approaching 7%. Oh, I love that number. You remember the other day we had almost $38 silver in a matter of just a short period of time. 6% loss in one day. It was like 6.38 or something, right? 6 point something percent loss on silver. Gold got slammed too, but not like silver, as usual. You know that old saying, what goes around comes around? Wonder if that has anything to do with this. CEO Jamie Dimon, speaking to analysts and reporters on a conference call, said the losses were caused by errors, sloppiness, and bad judgment. Errors? No. Sloppiness? No. Bad judgment? Yes. But the bad judgment was from day one when Jamie Dimon and the rest of these guys took over, and Blythe Masters, who was, my dad said he saw some interview a little while ago with her, and it was literally a handful of people, her and 3 or 4 others, just a few people, freshly out of college, big bright minds. Let's create this thing called derivatives. They are the ones that created these derivatives. And he was basically telling me what they said. They're in this little interview. Well, we were out of college, and we were putting our minds together, and we came up with these derivatives. And nobody knew it would be like this. Nobody knew that it would turn into what these are now. He was doing that, showing how they're basically, just a little, we didn't know that. Weapons of financial mass worldwide destruction. We didn't know that. Yeah. This was a unique thing we did, Jamie Dimon said. Obviously, it had a lot of problems. It was a bad strategy. It became more complex. It was poorly managed. Last month, rumors swirled around a J.P. Morgan employee, that's the guy, based in London, who had, according to the Wall Street Journal, been taking large positions in credit default swaps. That's insurance against bad bets. Or if you bought Greek bonds, hoping they would do well, you would buy credit default swaps to kind of hedge that in case they don't do well, and then you win. But I don't know what their positions exactly were. The bottom line is they lost, as expected. The employee, who said to work in the bank's chief investment office. Dimon was extremely agitated on the call Thursday with analysts. In response to repeated questioning, he said, quote, "I don't know how many more times I can say this." Make him say it again. Jamie Dimon, you prick. Say it one more time. Banking analyst Mike Mayo at investment firm CLSA asked whether the losses were due merely to terrible execution or also broader market forces. Quote, "In hindsight, this was bad execution, bad strategy, but also the environment, because this is mark to market," Jamie Dimon said. "But I just don't want to make excuses." Mayo pushed on whether market conditions were to blame, asking Dimon whether he thought other banks could be in the same situation. Were derivatives involved? Yeah. Then the answer is yes. There's definitely more banks involved. But let's see what he said to that question. "I don't know," Dimon replied, sighing audibly. "Just because we're stupid doesn't mean everyone else is." Still, investors appeared on edge as shares of Wells Fargo, Fortune 500, Goldman Sachs, Fortune 500, and Bank of America, Fortune 500, and Morgan Stanley, Fortune 500, were all down around 2% after hours. So the other banks, the boys, the club, the derivative gang, all their shares were down 2% plus after hours tonight. Should be an interesting day tomorrow. J.P. Morgan, on the other hand, was down 7%. Finally, Mayo asked Dimon what he should have paid more attention to in hindsight. Quote, "Trading losses," Dimon said simply, "and newspapers." Yeah, newspapers. That's probably what I should have paid more attention to. Another analyst asked about the terrible timing of the loss given the debate over the Volcker rule. That rule, a part of the Wall Street reform law passed in response to the financial crisis, That rule, a part of the Wall Street reform law passed in response to the financial crisis, aims to ban risky trading by banks for their own profit, a strategy sometimes referred to as proprietary trading. Quote, it's very unfortunate. It plays right into the hands of pundits out there, but that's life, Jamie Dimon said. Earlier in the call, he said, quote, I didn't violate the Volcker rule. It violated the Dimon principle. But Dimon was quick to defend JP Morgan's overall track record. Quote, when you look at all the things we've done, we've been very careful, and we've been quite successful. This obviously wasn't. Still, the loss could weigh heavily on the bank's net profits, especially if losses in the CIO unit accelerate. You don't think they're going to accelerate now with other banks too? Financial crisis staring us in the face again, big time. No, probably not. Something Dimon said is quite possible. What? Still, the loss could weigh heavily on the bank's net profits, especially if losses in the CIU unit accelerate. Something Dimon said is quite possible. So, Dimon, there could be more losses? This isn't the beginning of or just one little incident with Greece, bad bets on Greece. Obviously, it was Greece. Say, you don't think that... Well, let's back up here. Let me back up a little bit. Well, considering the size of Spain, they bet on Greece. Greece is tiny. Greece is the size of one of our small states in America. Spain is large. Spain is massive, economically speaking, compared to Greece. You don't think that Jamie Dimon and the boys in the Wells Fargo and the Bank of America and all these bozos did the same kind of betting on that debt also in Spain, Italy, France, etc. You don't think they did that, do you? No. It was probably just Greece only. That's probably all it was. But then you take his answer, it's quite possible that we'll see more losses. No, Mr. Dimon, you prick. It's not quite possible. It is 100% a guarantee. But we can't tell the sheeple that. We can't tell our shareholders that. What are we going to tell our shareholders? I know. Let's run with the story of, again, we're going to find this trader, this rogue trader. As a matter of fact, that was the CNN article. Because I want to cover that here. So let's go to this other article. Same story. Different site. And let's see. Where is this at? Hang on. Stupid ad. You know, gotta have ads popping up in your face right when you're trying to do something. Taking me off the page, as a matter of fact. We will fix it and move on. Okay. Now I've got another ad popping up my face. Hang on. I just want to read this one damn line. Stop with the freaking ads. We will fix it and move on. Most of the $2 billion in synthetic hedge losses have landed up after Q1 results, and quote, any individuals found to be responsible after these positions were discovered will be dealt with. Oh, okay. The rogue trader thing. Point the finger, the patsy. It'll probably be the whale. We're gonna dub him the whale. The whale did it. One single guy did it. Yeah, sure. You gotta tell your investors something. You're not gonna tell your investors we're a bunch of idiots. We created these things called derivatives. The people who created them actually work for us, as a matter of fact. And they're imploding as we speak. It's going to take the entire world's financial system down. But keep investing in us. Keep buying our shares. Right? You can't say that. You have to say this would have never have happened unless this one guy, or because of this one guy, that's why it happened. And we could see more losses because of some of the things he did. And then Bank of America is going to have losses. And then Wells Fargo is going to have... And you're going to... I mean, are they really going to pick a guy or two in every single banking entity and say, oh, we had a rogue trader here, rogue trader over there. Old MacDonald had a farm, E-I-E-I-O. And in his bank he had a rogue trader, E-I-E-I-O. With a rogue trader here, a rogue trader there, here a rogue, there a rogue, everywhere a rogue trader. I mean, seriously? Is that what we're going to be dealing with? Is that what the news is getting ready to throw in our faces? Rogue trader at Bank of America. Rogue trader at Wells Fargo. Rogue trader at JP Morgan. Goldman Sachs had 3 rogue traders. Ooh. Get the hell out of here. So, naturally, my brain's thinking of all these things that have happened over the last 2 or so months. Get the old gears turning. And reporting metals positions. I did a video on this probably a couple months ago. I can't remember if it comes straight out of the CFTC or if it comes out of the COT report through the CME group or wherever it comes from. But they have to tell you when there's a massive short position, or not necessarily short, but a big. I'm trying to think of what the rule is. Basically, they have to report. They had the rules changed a few years ago so that if it's just one bank that's holding a huge position, no one knows how much it is or who the bank is or anything. It's just one. If it's less than 4 that are doing it, in other words, if it's just JP Morgan, that counts as less than 4 people, entities. If it's JP Morgan and say HSBC, that's still under 4. They don't have to report it. But once that number gets to 4, institutions of that size or whatever with the big position, go have mommy do it. I'm busy. Then they have to report it. And just fairly recently, when I did the video a couple months ago, that number finally showed up as 4. They normally don't have to report the number. It's either less than 4, and that's all you know. So it could be 1, could be 2, could be 3. They don't report the number. So that means it's under 4. Now, all of a sudden, recently, the number showed 4. And when I did the video, I said, hey, is this what the... Is it just JP Morgan holding this single position, as I said 2 months ago, or was it JP Morgan getting partially out of their short position, handing it off to HSBC, maybe Wells Fargo, maybe Bank of America, and now all 4 of them split the big JP Morgan short position together. So now they have to report it. Because they knew coming up in the new future, which is where we're at now, JP Morgan's going to be in trouble. JP Morgan's going to be the first one to go down on this. So we can't have JP Morgan go down with its giant, massive silver short position on hand. We need to have our boys take over that so we can go and get in financial trouble, so to speak, and not have that short position destroy us. Because as Max Kaiser says, if the price of silver stays and remains for at least a little length of time, like a month or more, if the price of silver stays above JP Morgan's stock price, it'll destroy JP Morgan. And to date, that has never happened. We have had silver go above the stock price for at most 2 weeks. That's the most I've ever seen it. Boom, back down, JP Morgan goes higher. So now that this just happened, man, they just dropped down to like $37 or $38 for their stock, which is fantastic. I love it. So my question is, what will happen now if the stock price of JP Morgan goes below, let's say silver's hovering around 30, and then JP Morgan goes down to 28, 27, whatever? What will happen? Maybe nothing, because maybe they gave that short position, they spread it out evenly to their buddies. That's one possible thing that they did. My other thing is we didn't have the massive crash, which would have been this Monday, on the entire commodity market, which of course would include gold and silver, due to the 35% margin hike that the CME group said they had to do because of the new financial rules known as the Dodd-Frank Act that make them be a little more tightening down on instead of loosely allowing people 10-to-1 leverage and stuff, or 10, getting in with 10%, they now need to get in with 35% or whatever it is. And everyone complained and cried the blues, and they said, okay, we'll ask the CFTC if we can get an extension. It was approved, 90-day extension. So the 35% margin hike did not kick in gear, and here we have it. Today's Thursday, 4 days after that Monday, which 4 days ago Monday would have been the 35% market hike. All commodities would have been crashing. And then today, due to this announcement, all the banks are crashing down, especially JP Morgan. And this is after-hour trading. I'm curious how Friday will go. I don't know. But they wanted to do this so that the commodities could go down first. Then the banking stocks could come down, right? But that got put on hold. We got a 90-day extension because enough people cried foul to the CME group demanding that they not do this like that, asked for an extension. Okay, well, we can do that. They went to the CFTC. The CFTC, for if this is for a good reason, which it may be, it looks like now, once in their freaking life, said, yeah, okay, go ahead. Got a 90-day extension. So the commodities market didn't really get affected. And here we are 4 days later. What are the chances of this 4 days later that this news comes out? There's no way that this stuff is not timed and on a timeline or whatever. This is going to happen. We already know this months in advance, so we'll do this now. We'll get rid of our short position, hand it off to our banker friends because we're going to get in trouble. We don't want to get destroyed, so we'll get rid of that short position, let them hold it. We're going to go down in the tubes. But at least our other three guys, banks, they've got it. Then maybe one of those banks, Bank of America, you're next. You're going down the tubes. Hand that off to another bank. Hand off your portion of the short position. Okay, they're done. Wells Fargo, you're next. Hand off your short position to somebody else. And they're going to just keep handing off this short position. It's possible. I mean, they have to do something with it. They can't just go away. You know, it's there. So when it goes away, you have a Lehman Brothers type of situation where the whole market crashes down, which is what brought silver down to $10 from like 18 or 20 bucks or wherever it was at. You know, roughly somewhere around there. And because that short position supposedly went down with Lehman, and they had to liquidate it because Lehman went bankrupt, so they liquidate everything they have. This massive short position, these contracts they have, go out in the market all at once, flooding the market, naturally slams the price down. JP Morgan comes in, buys them up, and then takes also their short position, of course, for pennies on the dollar because now it's way down and Lehman's bankrupt. That's how that went down. So maybe they needed that badly so that they could make good money unloading their short positions. In other words, I wrote myself little notes. The 35% margin hike. They needed the CME group to put that in place now. We need it Monday morning. We need it immediately because we're in trouble. And since we've got a nice little chunk of short position in our possession, JP Morgan, the 35% margin hike is going to cause it to absolutely dive like never before. Sub $20 silver maybe. Just huge. And then, because we're short, we make a lot of money on that downward pressure. And then, when we talk about our group here that lost us a total of technically $4 billion, but, you know, the profit kicked in, so it's actually $2 billion loss. They could have walked away with a net profit instead of coming out right now saying, listen, we've got a, you know, basically a net loss. That 35% margin hike would have helped JP Morgan push the silver price down. Their short positions would have been great, paid them big time, and they may have got out of this mess without having to make this phone call today and said, hey, our profit's actually up significantly thanks to the crashing commodities that we all shorted, which didn't happen. So now you got to have to go out Thursday and sing your song and dance, Mr. Diamond. So I don't know if this 90 days extension technically is not some other scam they got going and I just can't see it yet. I have to wait for some things to unfold. Or was it really for us, the good guys, us people? You know, a lot of people complained to the CME group and they got the extension. So, you know, the CFTC could have said no extension and just let the prices dive. But I think the pressure, I mean, again, with commodities across the board, I mean, people would probably be filing lawsuits on the CFTC and the CME group for doing that, knowing full well they caused the prices to get destroyed. So we've got 90 days for that 35% margin hike. It's going to be very interesting to see what happens with the commodity markets over the next couple of months. This is just huge news for JP Morgan. It's not just going to be JP Morgan. It's going to be all the big banks. And again, Spain's in deep trouble. They've already had over 6% for their bond auctions. The rule of thumb, generally speaking, across the board, when you hit 6% on these bond auctions, that is a guaranteed sign you are done. Your country is done. You will not escape it. I don't care if the central banks or the ECB comes in and buys up like the Federal Reserve did last year, bought up 60% of all treasury auctions, our bonds. ECB could do the same thing and then cause the rates to go down. Artificially, of course, because they're buying it. Nonetheless, this is happening anyway. So you can imagine what those prices would probably ultimately go to if there was no central bank intervention. 6% would be laughed at. But the bottom line is that that's a sign of it's done. It's over. Spain's not going to cope. Italy, France, the rest of these guys, none of them can cope with this. They all, across the world, including our own country, have made promises. As the old saying goes, you wrote a check that your rear end can't cash. These politicians wrote a check, pensions, retirement, Social Security, that they cannot cash. It's not there. It was never there. It was designed to pull more money out of your paycheck so that they can use it now and then worry about it later. And when that later comes, well, I'll probably be dead. But the second generation of congressmen, they're still alive right now, and they're in office. And they haven't done anything to change it. So, it's going to be... I just right now, a Webbot report popped into my head. Massive amounts of resignations from Congress will be coming sometime in the near future, whether that means this year, next year, 2 years, I don't know. Massive resignations from Congress. Them people just quitting because they realize what they've done to the country. They realize how furious people are, and they don't want, okay, I'm leaving. Yeah, right. You caught the guy stealing your wallet. Oh, yeah, no, I didn't mean to do that. I was just, right, you were trying to take my wallet. No, okay, all right, I'm just going to go now. That's basically what's going to happen. So, that's my thoughts. That's my little video here. Take it for what it is. Man, do I love this. And I'm going to end this with an old school song I did back in NAM called the Max Kaiser Silver Liberation Army song.
Buy gold, buy silver, buy it for crashing banks. That's the way it should be. Buy gold, buy silver, don't play the paper game. Naturally, I had a dream, I had an awesome dream. The price of silver went to Mars, so I sold all of my bars. And the paper game is such a masquerade, and from behind the walls of doubt, Max Kaiser's voice was crying out. Buy silver, crash the banks, put it in your safe. That's where it's supposed to be. Buy silver, crash the banks, don't play the paper game. Naturally.
One more time. Let's do it one more time.
Buy gold, buy silver, buy it for crashing banks. That's the way it should be. Buy gold, buy silver, don't play the paper game. Naturally, I had a dream, I had an awesome dream. The price of silver went to Mars, so I sold all of my bars. And the paper game is such a masquerade, and from behind the walls of doubt, Max Kaiser's voice was crying out. Buy silver, crash the banks, put it in your safe. That's where it's supposed to be. Buy silver, crash the banks, don't play the paper game. Naturally, no matter who you are, silver's the shining star.